All right, good afternoon. Matt Giles back here with you, and it's been a couple weeks due to federal holidays and scheduling conflicts. Today is June 2nd, and that means here in Florida, hurricane season has officially begun. But that's not the only hurricane being talked about. The CEO of JP Morgan Bank, Jamie Dimon, just yesterday came out with a juicy headline: brace yourself for an economic hurricane. Whoa, pretty scary. And quite the reversal from just 10 days ago when he was saying the storm clouds over the US economy may dissipate. So which is it? Or going back to 2018 with a prediction of 10-year treasury yields of 5% when they only got to 3.25%. Or is it JP Morgan's global head of quantitative and derivatives research, Marko Kolanovic, who has it right, saying the S&P 500 will claw back its losses by year end? Confused? Before we put too much faith in any of these predictions, let's remember when hedge fund billionaire Bill Ackman went on CNBC in the early COVID days, actually crying, urging a complete shutdown of the economy. Then a few days later, it was revealed he had closed a hedge position which profits when the market goes down, netting a cool $2 billion and change. Lots of motives out there, and we should always ask ourselves, why am I seeing this now? Coming back to this year, let's turn to the crowd favorite drawdowns table updated through the end of May. S&P 500 off 13%, NASDAQ still down 23%, and small caps Russell 2000 down 17% for the year. We see all three indices are off their one-year lows, so this is how much each index has rebounded off the low. And here's the max drawdown from the most recent highs. So about 20, 30, and 30 respectively for the S&P 500, NASDAQ, and the Russell 2000. Now that the history books are closed for May, let's take a little breather and reflect. Look at this, the daily change in the S&P 500 for last month. One of the most volatile months on record, producing an intra-month drawdown of almost 8%. What was the end result of all this bouncing around? You'll need a magnifying glass to see the 0.01% positive return for the month. The history books will show a big yawn for the month of May, but looking back, it was anything but. Very similar to 2020, a year the history books will show as a great year, but not reflective of the volatility we all endured. And June doesn't just bring the start of hurricane season, it's also the start of QT, quantitative tightening, which is the common term for the Fed reducing its balance sheet. Just about everyone knows what the effects of QT will be. Less liquidity, stock market volatility, higher interest rates, right? Not so fast. This is an open letter to then Fed Chair Ben Bernanke, written at the very beginning of the original quantitative easing back in 2010, when the Fed was first expanding its balance sheet. Who signed this letter? Hedge fund billionaires, former chairs of the President's Council of Economic Advisors, former senior economists for the Federal Reserve, fancy Ivy League economists and professors, 24 of them in total, plenty of brain power. What did they say? Mr. Chairman, stop this quantitative easing. It will crash our currency and cause inflation, and it will not help with promoting employment. Well, only took a global pandemic, shutting down the world's largest manufacturer, China, and a war in large commodity-producing countries to create what these folks were concerned about over 10 years ago. Broad US dollar index looks pretty strong. Inflation, you couldn't buy it until last year. Employment, we're in one of the tightest labor markets in history. All this is to say, now that quantitative tightening is starting, there's not much history or precedent for how it will affect the market and economy. But just because everyone lines up with one narrative, even if they are hedge fund billionaires or fancy economists, it doesn't mean they really know. We prefer to use a much more rigorous analysis of how we forecast interest rates. They're simply a reflection of the current Fed chair's height. Let this be a reminder for all of us to be aware of spurious correlations. So, what does have our attention looking ahead through the summer and fall? Cash out refis, a record as a percentage of total refinancing activity. Should we get a round of layoffs in the months ahead, which we're just barely starting to see? This will be interesting to watch. Combine that with home buyer mortgage payments at 42% higher compared to last year. Folks saving less in yellow, lowest personal savings rate since 2008. Borrowing more in blue, revolving credit, basically credit cards. So while we see a strong consumer now, great employment figures, there are some cracks beginning to show beneath the surface. Is there a silver lining? Perhaps. Again, we don't like to use the past as a precise template for what must happen in the future, but there is something about midterm election years. As we've looked at many times this year, there's often a grind down through October, only to turn up in the last quarter of the year. And in fact, if you look at 1 year gains after the midterm elections, so this would be starting in November, stocks have gained every single midterm election year since 1950. 18 for 18, with an average gain of 14.7%. Despite the tough year so far, we hope you're enjoying the start of your summer. Thanks for watching. We'll see you again soon.